Here's a question that can dramatically change how profitable a company looks. When a company spends money, does that spending hit the profit line this year or get spread across the years that benefit from it? Those are the two accounting treatments we're looking at today. Operating expenses, or Opex, are consumed in running the business. Capital expenditures, or CAPEX, purchase or improve assets the business will use over time. Same cash out the door, very different timing on the income statement. Let's spend $1 million two ways and watch what happens. First way, Redline incurs $1 million of operating expenses, things like salaries, rent, utilities, and materials consumed in production. This is Opex, the cost of running the business day to day. It gets recognized as an expense as the benefit is consumed. In our simplified example, the full million comes off this year's profit. Spend $1 million as Opex, and this year's profit falls by $1 million. Simple and immediate. Now the second way. Redline spends the same $1 million on a machine it expects to use for 10 years. This is CAPEX, money spent on a long-lived asset. The cash still leaves immediately, but the full million does not hit profit immediately. The machine goes onto the balance sheet as an asset, and its cost is recognized gradually through depreciation. Assuming 10-year straight-line depreciation, no salvage value, and a full year in service, that means $100,000 of depreciation this year. So the same $1 million cash payment reduces this year's profit by only $100,000. The remaining $900,000 stays in the asset's book value and will be recognized as depreciation in future years. Look at what just happened. The same $1 million of cash left the business both times. But in our example, Opex reduced this year's profit by $1 million, while CAPEX reduced it by only $100,000 through depreciation. 10 times the difference in this year's profit, even though the same amount of cash went out. That's why the CAPEX versus Opex distinction matters. The classification determines when the cost reaches the income statement. Treat a qualifying expenditure as an asset, and more of the expense moves into future periods. Treat it as Opex, and the cost reaches earnings much sooner. The cash payment hasn't changed. The timing of the profit impact has. So where do you find each one? Opex appears on the income statement. It shows up in cost of goods sold and operating expense lines such as SG&A and research and development. Redline recognized about $130 million of operating costs this year, and those costs are reflected on its profit and loss statement. CAPEX lives somewhere else. The cash payment appears on the cash flow statement under investing activities, while the acquired asset appears on the balance sheet. Redline's fiscal 2025 CAPEX was $5.2 million. And that $5.2 million does not appear as a CAPEX expense on the income statement. Instead, the profit and loss statement shows depreciation from Redline's broader depreciable asset base, including investments made in prior years. That depreciation was $4.2 million in fiscal 2025. CAPEX reaches the income statement over time, not necessarily in the same amount or in the same year as the cash expenditure. Most spending is straightforward. Salaries are Opex. Buying a new building is CAPEX. But some expenditures require genuine accounting judgment. Is a major machine overhaul an ordinary repair, which is expensed? Or is it an improvement that extends the machine's useful life, which may be capitalized? Do software development costs qualify as an asset, or must they be expensed? These decisions are governed by accounting rules, but applying those rules can require judgment, and the choice matters. Capitalizing a qualifying cost delays part of the expense and raises current period earnings compared with expensing it immediately. That does not mean capitalization is improper. It is often exactly the right accounting. It does mean auditors examine the support, consistency, and useful life assumptions. and analysts pay attention to what is being capitalized and how those policies change over time. And this connects directly back to EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. Because depreciation is added back, EBITDA does not reflect the cost of CAPEX, as that cost moves through the income statement. And because the original CAPEX payment appears in investing cash flow, not operating profit, EBITDA does not capture that cash outflow either. Look at Redline. Operating cash flow was $2.3 million. CAPEX was $5.2 million. Subtract CAPEX from operating cash flow, and Redline's cash after CAPEX was negative by roughly $2.9 million. That does not automatically mean the business performed poorly. Redline was investing in long-lived assets, and in this case, the funding gap was supported through the revolver. But it does mean the $23 million of EBITDA did not translate into cash available after those investments. EBITDA tells us something important about operating performance. It does not tell us how much cash remains after CAPEX. So here's the read. Opex is generally the cost of operating the business today. CAPEX is the cost of acquiring or improving assets that will benefit the business over time. Neither is automatically good or bad. A company spending too little on CAPEX may be allowing its equipment and systems to age. A company spending heavily may be building capacity for growth, or investing without earning an adequate return. To understand the cash result, we take operating cash flow and subtract CAPEX. That gives us a commonly used measure of free cash flow, the cash remaining after the company's operating activities and capital investment. For Redline, that number was negative in fiscal 2025 because CAPEX exceeded operating cash flow. Next, we'll look at free cash flow directly, what it measures, what it misses, and why it often tells a very different story from EBITDA. And to see decisions like these made under real pressure, with management explaining why CAPEX is over budget, that's where the main series comes in. Every line ties back to the dollar.